thanks everybody to be here, and I hope you have had a very good Easter break and recharged for the rest of the academic year. So today we have very good speaker, I would say, Professor Niels Hermes, who is a full professor from University of Groningen, the place that I did my PhD. And actually, I met Niels while I was in Groningen already. And interestingly, we shared the same supervisor, at least one, Robert Lensink. So we worked with Robert respectively for years, and we know each other for a long time. So it's so good to have you, Niels, to be here. And Niels, actually, you see a very short introduction of himself, but it has a lot in the background. So we just escaped the details, but you can see that Niels has been in the Faculty of Economics at University of Groningen for a long time. And he is now a visiting professor in different places, including Belgium and Tanzania and South Africa. So as you can see. And very, very concise. You see Niels has been paying a lot of attention to his research. It covered a variety of different sub-areas. And recently, Niels focuses on corporate governance. And he has obviously a hardworking academics for a long time, and also very creative. And the publication, you can see that has news publications have appeared in top journals, such as the Economic Journal, Journal of World Business, World Development, Journal of Banking and Finance, Journal of Economic Surveys, and Corporate Governance and International Review. And what is new to me and exciting news for me as well is that Niels is now the president of the International Corporate Governance Society, and he's the editor of that journal of the society, Corporate Governance and International Review. By the way, when I was doing my PhD, I tried this journal as well. So well done, Niels. A very good journal. We have seen so many new journals, but this one has been established for a long time, and people who has been working in corporate governance, they all know this journal. So it's really a pleasure for us to have you, Niels. And also, importantly, the topic is very, very interesting. So today's topic is about sharing non-executive directors for a non-financial firm, and particularly it's a private non-financial firm. So as you can see, this is a corporate governance and corporate finance and also financial system, etc., etc. So we are very, very excited to have you. And Niels, you can take over the floor, and then let's see whether we have, do you mind if people raise questions in between your presentation?
Sure.
So we can be interactive. Sure. And the purpose is to make this discussion more constructive. Niels, welcome, and thank you very much for your support.
Thank you very much for this very, very nice introduction. Indeed, we know each other quite long. And so thank you very much for inviting me. Actually, this is the second time that I'm presenting for this group in this seminar. I'm not sure when it was, but I did a paper, I think last year, also for the seminar series on also on board, corporate governance paper. And I liked it very much. So lots of interaction. So please, if you have questions along the way, then let me know. I can't see you because in the system that we have, Teams, I as a presenter cannot see the audience, but I guess I hear some bleep or something when someone raises his hand or her hand, right?
Yeah,
So,
I'm here, Niels.
yeah.
Yeah.
So, okay. So let me start with the paper. So this is a paper that I jointly write with people from Copenhagen Business School. At Copenhagen Business School, there is a Center for Corporate Governance. I've been there for 3 months last year as a visitor, and I started working with Thomas Polsen, who is an associate professor over there, with Chaglar Kaya. He has a postdoc position and now is at Aalborg University, also in Denmark. And then finally with Niels Vestergaard Nielsen. He's a retired professor at CBS. So this project started over there, and well, it went quite slowly in the beginning, and but now recently, because I go back to Denmark next week for again a research visit, this time for 2 weeks, the paper really got some more traction, so we worked a bit more on this. But I have to say, it is a very first draft of a paper on the topic of board interlocks and bank loans. We are still working on it very much. So what I will present is a very first draft, and I'm very happy. I would be very happy if I could get feedback from you on several things. One thing is the positioning of the paper. What do you think should be the main message? What's the most interesting message, or maybe there is a message not there that should be in. So it's about the positioning, and then of course also about the econometrics. That's always an issue. What I will show, I think, is basically now is some sort of correlations, some things that point into a certain direction, but it's very difficult to make that really causal. So I'm very happy to get all kinds of comments from your side on these topics. So let me start with the introductions, and this is already has to do something with, let's say, the positioning of the paper. So the paper is about interlocks and bank loans, but the focus, the data set actually is entirely private firms. So we have a data set of only private non-listed firms, all from Denmark. And well, one way to position the paper is to say that private firms are a very important part of the economy. They provide a lot of employment. They provide a lot of value added to the economies, and I've given you some numbers here in the EU. So private firms are a very important set of firms to look at. And interestingly, if you look at the corporate governance literature, private firms are much less studied than public listed firms, for a good reason, because for private firms there is much less information available. Information is less structured. There are less, let's say, disclosure rules for private firms. There's less following of analysts, credit ratings. So there is, in general, there's less information about private firms, which makes research on corporate governance much more difficult. So that could also be the focus of the paper, of course. But let's see what else, what other messages we could learn from this paper. So one thing that is particularly interesting and also important when we talk about private firms is the way they finance themselves. And if you know a bit of the literature about private firms, so the main source of external finance is coming from banks. So bank loans are the most important source of external finance for private firms. They don't have access to equity. Trade credit is available, but that's a very short-term type of credit. Bonds are relatively difficult for them. So bank loans is a very important source of external finance. So for their growth, for the sustainability, for the survival, access to bank loans is very, very important. At the same time, it may also be difficult for private firms to get access to loans, to bank loans. And this is again to do with the fact that between the bank and the private firms, there is quite some asymmetric information because of the lack of transparency, because of the lack of information, disclosure obligations, reporting, etc., etc. That makes it more difficult for banks to evaluate private firms and to be able to fairly know what the risk and the creditworthiness of these private firms is. So that is a problem in itself. So that leads to the question whether certain governance mechanisms are available that would help, that would assist private firms to get a better access to loans and maybe also better conditions under which loans are being provided. And in this paper, we focused on the phenomenon of bank board interlocks. And I guess you might be familiar with this, but just to give you a picture of what it means. So this is a very, very, let's say, simple way of showing what interlocks means. You have 4 companies in the example and 11 board of directors, members of the board of directors. And if you look at board member B, D, F, G, Y, and the F and Y, so these board members of the different firms, they have positions in 2 firms. And by having these positions in 2 firms, in this very simple example, they actually connect the 2 firms. And if you go a bit deeper into the structure of this simple example, you can see on the left-hand side, in the bottom, you can see how the firms are connected. So firm 2 is very much connected to all the other 3 firms because board members of firm 2 have connections to all of the other 3 firms in this example, whereas firm 1 is only connected by these board interlocks to firm 2. And the networks of board of directors makes that a bit more clear because especially board member B and board member D, they are very central in this whole structure because they are they have 6 different connections to other people from the same or other firms. So these connections, these are, you could say, channels of transmission between firms of all sorts of things, basically of information, of norms and values, or even of resources. And that is why we would like to focus on these interlocks in this setting of private firms and access to bank loans.
Niels, I
Yes.
saw a hand.
Okay.
So we allow the hand. Is my colleague from Bangor University. So Yanan, please.
Thank you, Hong, and thank you. Niels, you mentioned that the banks doesn't access the information when they issue the loans to firms, and then that's why you are looking for the this justification as a board directors. But I'm a little bit I have a comment on these things, and banks, when they issue the loans, banks ask the firm at every information they want to hear or they want to see. So firm, in order to finalize the loan contract, firm obey or provide the financial institution. On this aspect, I'm a little bit puzzled to your justification about the banking firm loan contract and not access the detailed informations.
Maybe, okay, I understand the question. Maybe I was not clear about it. Of course, it's not like there is no information. Of course, the bank will ask the firm to give information, but in general, the information that is around, that's publicly available for banks to evaluate firms, is less for private firms. So the bank should ask this information to the private firm. And what I will stress in the paper is actually is related to your question. I think that by having people on your board who have a link to the financial sector, especially to the banking sector, you are better able to provide the information the bank needs to make this, to make a bank loan decision. That's the information that flows from bank boards to the firm that would like, the private firm that would like to have a loan from a bank. So indeed, of course, the bank will ask questions to the firm for information to make an evaluation of a loan, to provide a loan, and then also to set the conditions. The fact that the firm has a interconnection, an interlock with a bank, provides information about how to provide that type of information in such a way that the let's say the probability of getting the loan and getting good conditions is higher.
Thank you.
Does that make sense?
Yeah, that is fine. That's what. Yes, I can understand that you are looking at the soft information through the executives who are sharing the position. It's perfect.
Yeah. So now I'm basically selling the main story already. That's the main story about these interlocks, the soft information, as you call this. I will call it tacit information, but that's exactly what the idea is behind these interlocks. And we call them shared directives. This is just a term that we have used in this paper, but this is the idea, right? This is the idea about interlocks between private firms and bank organizations. So the research question is, does the presence of shared directors on the board of private firms shape the credit relationship between the firm and the banking sector? That's what we try to research here. And we use data from, I already mentioned, because this is a project that I did when I was in Denmark last year. It started over there. We have Danish information about Danish private firms, more than 40,000 unique firms for a period of 2003 to 2019. And the main findings are actually, there are three main findings, and two of them are maybe pretty standard, or you might expect them. If you believe in the story that these interlocks might indeed be valuable for private firms. The first is that if firms have a so-called share director on their board, then they have a higher likelihood of having a bank loan, and they also pay a lower interest rate spreads, so they also get better conditions. That's one, and the other one of the other findings is that this impact these shared directors may have is largest for those firms who need loans most, and that's in our one of the settings we are looking at is in those settings where firms are really financially constrained. So these might be maybe results to be expected, but the main message that I think at least I would like to discuss with you, that is how actually this works. So what is the main mechanism here? And the main mechanism is the fact that in such an interlock, there is information involved, information that is shared, and that information is about the banking practice. So these people who are on the board of a bank and on the board of a firm, they may have banking expertise. And I explicitly want to say they may have this expertise, because you can, of course, also have a situation where a director on the board of a bank is not a banker, him or herself, or does not have necessarily banking expertise. Now we're looking at those people who are on the board of a bank and on the board of a private firm who have banking expertise. And that brings this information to the table that helps the private the private firm to get better access to loans and financial conditions. So the channel is banking expertise, and it's not, and I'll show you some, let's say, correlations once again that seem to support this. It's not about the organizational tie. So it's not like the private firm is linked to a bank and that bank is then lending money to the firm. So it's not the organizational tie that matters. It's really the expertise story that is apparently running the story here, the channel. Right? Is that making sense? I'm going to, of course, elaborate on this, but that will be my main story. And because of specifically this channel story, I think we add to two literatures, to two different literatures, because there is a literature in this field that looks at firms and firms having bank executives on their boards. This is not an interlock, but this is a firm, and this literature is mostly on public firms, so listed firms. But this literature shows that if a firm has a bank executive on the board, then also there is a better access to loans, and there also are better loan conditions. But there, the main channel is the tie with the banking organization who lends the money. Because the idea of this is, in this literature, that the executive is having control over bank loan decisions. So there, the tie with the organization is crucial, and the fact that the executive has some sort of control over loan decisions, whereas we look at directors who have no control, they have no control of loan decisions, but what they can bring to the table is this information about how the bank or banks in general might decide on providing loans and conditions. And the paper adds to the interlock literature in two ways. First of all, this is one of the first papers that looks at private firms and the role of interlocks. There is a recent paper published in 2024 by Benischke. I have to look it up myself. Benischke and colleagues in the Journal of Management, and they also look at interlocks for private firms, but then they look at interlocks between private firms and public firms. So there's a different context, but there is not so much literature on this interlock story for private firms. And at the same time, you could say that maybe for private firms, these interlocks are maybe even more relevant than for public firms, because private firms typically have more difficulties to get access to all kinds of resources, external resources, they don't have internally. So having interlocks for private firms is quite relevant, but at the same time, we don't know too much about how that works. So that's one. And the other thing is that what we think we can add to the board interlock literature is that the board interlock literature very much focuses on the fact that there is an interlock as such, but not really goes into this discussion about what specifically the interlock has content-wise. And whereas we try to let's say to stress that what the interlocking board member brings to the table here for the private firm, that's ultimately what's important. And like I said, once again, in our case, it is this banking expertise that is important. So that's basically, I think, what we add to the existing literature. Now, I call this theory, but it's the next part, but we still need to develop this more, and it's revolving around the story that I already discussed with you about board interlocks having access to certain information, especially tacit information. That's the main story, that's the main theory, but I think we need to strengthen that story. But it starts with, let's say, the basic idea about what boards do. If you are in corporate governance, you know this. Boards have two main roles. Sometimes it's three. Also, strategy can be a separate role. Sometimes that's also part of the resource provisioning role. But let me make it easy. Boards have two main roles. One is the monitoring role, and the monitoring role that gets quite some let's say focus in the research. In academia, but also in practice. If you look at, for instance, codes of corporate governance, lots of what is in the codes of corporate governance is driven by the importance of the monitoring role of boards. So boards should be having independent members. They should not have too many positions in different boards. the importance of, let's say, disclosure. Everything is focused on monitoring as a very important role the board plays in companies. And then there is the second role, and that's the resource provisioning role. So the board can be a very important mechanism for firms to get access to external resources. And so the fact that board members have a certain background, they have certain knowledge, they have certain expertise, that helps the firm to get access to external resources like finance. And that can either be because they have control over those resources outside, talking about these bank executives, for instance, or they might be able to connect the firm to those resources by having this background. So this is the two main roles that you usually see in the literature, and we will focus mainly on this resource provisioning role. I would argue that for private firms, I already alluded to that a little bit. I would argue that whereas for public firms, this monitoring role is quite important. So for firms where separation of owners and managers is strong and where you have widespread ownership, agency problems are usually very strong, and so monitoring is important. For private firms, I'm not saying that there is no agency problems in private firms, but these, let's say, problems they might have, the difficulties they might have with getting access to external resources, such as finance, that might be also very important for private firms, and maybe even more for private firms as compared to public firms. So focusing on this resource provisioning role is, I think, very important for especially private firms. So what does a director, a board member, what does this person bring to the table? What is important? Well, it is important that this person brings external connections over which he or she has control or can give access to. This is, of course, one dimension. And the other dimension is to what extent these resources are important for the firm. And in my context, in this paper, we are talking about finance, bank loans, and that's a highly relevant source for private firms. So that's why we focus on these board interlocks, especially board interlocks, because board interlocks is one way a board of a firm might manage the access to external resources. These connections to other firms, the fact that there is this so-called dual embeddedness, I showed you this when I showed you the picture, this very simple picture of board interlocks. This provides this idea of flowing of information, of practices. If you think about the context that we are talking about here, the bank practices that are used, norms and values that are maybe important. So this is what flows through these connections from one firm to the other. And then that information,
Niels, so at this stage, maybe I should ask a question because this is related to the theory.
Yep.
So you mentioned the monitoring role, you mentioned the resource-based will theory, let's say resource prevention. And to me, I think this is something to do with board diversity as well. Mm-hmm. So board diversity, of course, you can talk about gender diversity, cultural diversity, expertise diversity. So what do you think about this diversity, board diversity? Is this something, maybe we can see this as a sub stream of theory and resource-based view? That's my first question. Related to this, secondly, you emphasize the interlock. Yep. So what happens if I, as a private firm, I have, I appoint other, non-executive directors who are not necessarily sitting on other boards, but they do have expertise. So what are the differences between those two scenarios?
Yeah, that's a good question, and I will show you. But I do acknowledge that I'm talking about correlations still at this stage of the project, because we're not yet at the level that we can really claim causality. But I will show you some let's say some early evidence that it really is the combination of being a shared director, so an interlock, and the banking experience that does make it work. So if we also add a variable where we have information about those board members who also have experience in banking but are not at the board of a bank, then that doesn't help in getting better access or getting better interest rates conditions. So it's really the combination of the two. And the question is, why would that be important? Well, I think that, so like I say here, the interlock, that makes it possible that information flows directly from what happens in the bank board, discussions that are going around there about loan conditions, about loan strategies. So the discussion in those boards, information about that flows directly to the firm. So the firm, in addition to maybe having information from non-executives who are not in those bank boards about banking conditions, that information that adds to the information they need to make successful bank applications and get loan conditions that are how do you call this? That are, well, better than normal. They get better loan conditions. So it really, I will show you some results about this, but it's really the combination of the interlock and the information that this interlock about banking conditions, about banking practices, that does the trick here.
Okay.
And your question about board diversity, you started saying that monitoring and resource dependency, the two main roles of the board. Board diversity has, of course, potentially many implications. We do not explicitly look at board diversity here. We could take this as a control variable. That we could definitely do that. But I don't exactly see now how board diversity is related to the story about having better access to bank loans and better loan conditions when you have higher board diversity or lower board diversity. I'm not sure which way the theory should guide us.
Yeah. Okay. Yeah. Thank you. Well, well explained. So I see my colleague's hand, Tulu. Tulu has been working in corporate governance quite heavily, actually. So Tulu, do you have a question?
Yes, thank you. Interesting presentation so far. I just wanted to circle back to the theory and the motivation you started with, which relates to network. I am not sure if you get there, but I wonder if you are also applying network and theory in motivating your hypothesis, which may also affect the way you set up the econometrics. By this, I meant if you are applying network and theory, for example, you may want to also measure the strength of the interlocks, whether the strength of the network, the interlocks between the directors actually affect your results. And there you'll be calculating, measuring concepts like centrality and betweenness.
Well, that's a very good point, Tulu. I think, no, at this stage we are not so far to also take into account the strength of the interlocks. I know this literature, of course, and this could be something to deal with. The question is to what extent the strength of an interlock affects the information that is transferred?
Yeah.
That is, of course, the question. I mean, on the one hand, I can see that maybe there is a role to play for the strength of the interlock. At the same time, our story is mainly you have a director in your firm who is also a member of a board of a bank, and that is a tie that's most important, because that is the one that gets you the information you might need. Is that affected by the strength of the interlock? I'm not sure. So this is why we not yet went into this direction, but it is something to look at, and we have all the information, so we can do this. No, I would not say easily, but we can do this. Do you understand?
But Niels,
yeah.
If I appoint a person who is sitting on the bank's board, I can hire either a very senior, or maybe the CEO of that board, or the chairman of that board, or I just have somebody who is a normal, ordinary non-executive director. So do you think if I have the CEO from that board will convey more useful information to my firm?
Well, this is exactly, so that's why I was thinking about this network centrality and the strength of interlock story. I think it's much, to me at least now, it's much more important to know a bit more about who this interlock actually is. What kind of position does this person have? We look at the history of people in banking. That's what we measure, basically. And by now, we still have a very simple measure, which is the dummy variable. Is there someone with banking history? But what we are currently collecting is information about the history of a person in banking. So how many years in banking, what positions in banking? I think that's more important to know, to say something about the value of the information that this person might provide to the firm, than maybe the centrality of that person in the network. Although you could say, one thing you could say is that if this person is very central, then this person might get more information from other sources, him or herself as well, which may make the value of the information that this person holds also more valid for the firm. That might be indeed a story that would point out that we should maybe also take into account the strength of interlocks. But right now, we are much more focusing on what type of person is this in terms of his or her banking experience.
Mm.
And I'm going to show you, like I said, this is a very rudimentary first version with mainly the correlations rather than causal relations. We now use a dummy variable that already gives us some interesting results. And we would like to go deeper when we have more information about this type of
Okay, great. So let's continue the news. Yeah.
But I very much do like the suggestion made by Tulu.
Yeah, thank you.
Yeah.
So we can go ahead. Yeah, please.
Okay. Just looking at the watch.
Thank you.
Okay. Let me see. Where was I? Yeah. So it is about this tacit knowledge that is flowing through these network interlocks. This is basically what I already mentioned. Related literature, I already mentioned that as well. And I would like to once again stress that this is really something else than the literature on bank executives, because they have a different role to play. They have a different position in the bank where they're from. They can also help firms to get better access to loans and better loan conditions. But that's there is a different channel there. And that the channel there is the organizational tie. And you might ask, maybe someone is thinking about this, but you might ask, okay, maybe a firm has both, so a bank executive and a bank non-executive. The institutional setting where we are working with in Denmark, private firms, does not allow this. So what we get is a clean effect of the non-executives and their effects on bank loan access and bank costs. And so it's not possible to have the bank executives and bank non-executives in one. So, but I think it's important to set us apart from this literature on bank executives. That is a wide literature out there. Once again, it's on public firms, I have to say, but to make clear what we do differently. Okay, now the hypothesis is very simple. I'm just looking at, does it have an effect on bank loans, access to bank loans? Does it have an effect on cost of bank loans? And then this split into financially constrained firms and high and low financially constrained firms. That's a very simple setup right now. But I would say the main contribution is not so much showing this as such, but it's more about the channel, about the fact that it is this banking expertise, banking practices information that flows through interlocks. That's the real story. So I'll guide you through what we currently have. And so let me first say where the data are from. I'm not sure whether you're familiar with the Danish context when it comes to data, but like Norway and Sweden, data availability in these Scandinavian countries is quite extraordinary. So I'm happy to work with Danish colleagues because that gives us access to all kinds of large data sets where we can get detailed information also on private firms about their loans. So I have information, or we have information about loans in terms of the amount, the interest rates they pay, the maturity. We have information about board level data, which, like I said, is not that easy for private firms, but we have fairly detailed information as well. We have all firm level data, from performance data. So this data is quite detailed, and we have that information for 2003 until 2019. And overall, like I already mentioned in the beginning, we have more than 40,000 unique firms. And then we have 7,000 of them that have a loan. And for that, we can run regressions with respect to this interest rate spread that we are focusing on as a measure of the cost of banks and bank loans. So let me see where I was going to say something about that. Maybe next. Yeah. So very simple. We run, first of all, to test this bank loan access story. We have a linear probability model using firm and time fixed effects. The dummy variable is the dependent variable. Does a firm have a bank loan, yes or no? And then the key variable is a variable that's an indicator variable or a share variable or a number variable indicating whether or not there are those shared directors on the board of the private firm. And I have to mention that, so that this is important for the story, we have this information about shared directors. We have two types of them. One is the so-called affiliated shared director. So that's a shared director that has a board position in a bank of which the firm is borrowing money. So that's an affiliated shared director. And then, of course, we have non-affiliated shared directors. Those are board members in private firms who have a board position in a bank, but not in a bank from which the firm is lending money, borrowing money. So that's important to understand, so that you can understand what we're going to do next. So that's what we do for hypothesis 1. For hypothesis 2, we look at this interest rate spread as our main dependent variable. That's very simple. We take the interest rate that the firm pays and we subtract the so-called CIBOR. This is the Copenhagen interbanking offered rate. We subtract that from that, and this is the spread that we are calculating. And we run the same model. We run the model with the same independent variable, this shared director variable. We do this with fixed effects, and we have some entropy balancing. We try to do something right now to solve causality issues, but I assure you this is not by far not enough for getting this paper.
So, Niels,
yeah.
we have a hand from my colleagues from the same department. Harry, please.
Yep.
Thank you very much for the wonderful presentation. Yeah, I'm enjoying so far. I have a question. I'm just trying to understand. Are you considering only those firms they are levered from? They borrow money, or these are all the firms they are in your sample? Because it may be related to the firm's decision whether to borrow the bank loans or raise the funds by using the means of debt or not. So here, your points looks like the firm access to the bank loan, but some firms may not be interested to borrow any amount of the bank loan. So how you have positioned this, and what is the sample over here? Are these only the levered firm, and we know that they want, let's say, 50% or 40%, or they have identified they want to go for the debt? I'm curious about that. Yeah.
Yeah. No, also that's a valid question. So right now we take all firms into account in this first regression. So all firms are in there.
So in that case, there may be a problem because it may be the company's or the board's decision about their capital structure. Okay, let's say my firm does not want to borrow any money, so we do not want to add the financial risk. Whereas some other companies, similar firms, they might want to borrow the money or maybe go for 90% or maybe above the leverage. So until and unless we identify whether they have, I mean, what sort of capital structures do they have, or maybe in the process of matching these firms, as you are trying for the entropy, maybe what is their structure, financial structure, okay? At least segregate them. Okay, yeah, and then based on their capital structure or the leverage ratio, maybe we can go for the propensity score matching. That may be something as a feedback. Thank you very much.
Which is what we do, right? That's what we do. But I do agree that this is not the ideal way to separate those who may not want to borrow from those who do need the money. To some extent, this financially. So to some extent, the let's say the hypothesis 3, where we look into financially constrained firms, might give us information about that. And because those firms they are financially they are in need of finance, so they might actually want to go for a loan. So if for those firms, if they also are, let's say, being helped by these interlocks, that might give you more information about this. You understand, or is that?
Yeah, all right. There are a few more thoughts. Maybe we can discuss later once you finish the presentation.
Yeah. Thank you, Harry. Yes. So, Niels, we can continue, please. Yeah.
Okay.
Very interesting topic and a lot of questions.
Yeah, sure. I was hoping for that because, like I said, we are at the beginning, so we would like to have some input here. So this is the way coming back to the question, this is the way we measure financial constraints. We use this Hadlock-Pierce index, where you have this, let's say, the equation, and you. Not sure whether you know this paper, a review of financial studies, but they have they provided this index, and then at the firm level, you can come up with a number for this index based upon the size of the company and the age of the company. Those are the two main variables that are important here. And what we did, we calculated this index for all firms, and then take the top 1/3 of firms, very roughly. We can also play around with that number, of course, to classify firms in being financially constrained versus financially less or non-constrained. And we use that as a dummy in the regressions when we try to find out whether financially constrained firms are having better access once they go to bank loan if they have an interlock. That's the story. So that's what I'll show you in a minute, but that's what we do to test this financially constrained story. So the results, this is the main descriptive statistics table. There's lots of things that I could point out. So one thing is that if you look at the full sample for all firms, then you can see that the number of these shared directors is not very high. The number of shared directors is higher when we only look at these loan level regressions. So where we try to find out whether these interlocks help in reducing the cost of the loan for the firm. So that's something to point out. Yeah, for the rest, you can see the interest rate, the maturity is there. So maybe good to point out the last 3 rows or 2 rows maybe in the lower panel. So I talked about these affiliated share directors. So once again, these are share directors who have a bank board position in the bank that provides the loan to the firm. That's an important variable in our story. And the other variable that's important is whether a shared director has actually this expertise. This is called here financial expertise, but actually it should be banking expertise. And that's so half of our people who are, let's say, classified as a shared director, they actually have this banking expertise. So that means that not all of these shared directors, people who are at the board of the firm and in the board of the bank, they actually have this important information they can carry through, they can provide. So it's indeed important to make a separation between what kind of people they are, these share directors, in terms of whether they have banking expertise, yes or no. Okay, now the very first regression is about the whole sample. And we see that apparently if you have this interlock, this shared director, then you have better access to bank loans as a firm. And we use 3 different measures here. So the simple dummy, the number of share directors in your board, and the share of share directors. So the number of share directors divided by the board size. Basically the same results. You can also see that the economic, so statistically it's significant, but economically it's actually not very significant. It's 1.3% higher. The probability of getting a loan is 1.3% higher if you have a share director. So maybe at the level of getting access to loans, there is an effect, but it's not very strong. That's at least my reading from these results. If we then go to the interest rate, so the cost of the bank loan, there it seems that having a relationship via an interlock, a shared director, there it seems to be more interesting. So if you look at the first result here, the first column, then you see that if you have a shared director as a private firm, you might be able to, on average, get a 35.3 basis points reduction of your interest rate. And this is 12% of the average interest rate in the sample. So that seems to be an economically significant reduction that firms seem to be able to get when they have this shared director. So those 2 results, very simple, but they seem to indicate in a certain direction. Now, the most important thing, once again, is about this mechanism, this channel. So in this table, what we do here is we look at this affiliated share directors and non-affiliated share directors, and we look at this interest rate spread again. And what you see here is what this table suggests is that these affiliated share directors, so the ones who are a board member in the bank that provides the loan to the firm, they have the strongest effect. So this, you could say, indicates that the organizational tie is important. And the results survive if you put them together in let's say, column 3. We also did a test to see whether these coefficients are statistically significantly different from each other, and that indeed is the case. So this table suggests that the organizational tie is important. But then we move on and we bring in this banking expertise story. The information that runs through the interlock from the bank to the firm. And then the picture changes. Because in column 1, I copied the last column of the previous table. So that's the result from the previous table. But then if we add to that regression, we add this variable that picks up whether a share director has banking expertise, then the results for the affiliated and non-affiliated share directors disappears. And everything is picked up by the fact that the share director has financial expertise. If we run the regression with only this share director financial expertise variable, then we get the same result. Column 4 is where we add, what was column 4 again? Oh yeah, column 4 is also very important. That comes back to the question that I think was asked before, because you could ask the question, is it really financial or banking expertise in a shared director, or can also someone who is not a shared director, so someone who is a board member but is not a member of a bank, having this expertise, does that maybe also bring something to the table? And the answer is no. Yeah, because if we add this non-shared director financial expertise variable to this regression, that doesn't really get any results. So it is really about the combination of the shared director, a director that is also a member of a bank board, that and the fact that this person has financial expertise, that seems to be the main story. What we also try to do here, to put it in a different perspective, is to see, is this specific for the bank from which the firm gets a loan, or is it a more general effect? So does this information that this shared director provides in terms of banking expertise, does this maybe also help the bank to get loans from other banks? And the answer is yes, it is a general effect, because if we try to see to what extent having a loan from a bank of which your board member is part of the board, then that doesn't really add anything to reducing the interest rate spread. So it is a general effect. It is not a effect that relates to the bank to which the firm has a relationship. So I would say overall, these very preliminary results, they point out that information in a tie, in an interlock, information about banking practices, that is what drives the results here. And finally, to show you the results for these financially constrained firms, and maybe we should much more push this as the main results when it comes to also the bank loans, although here we do this interest rate spreads as the main dependent variable. We see that what is maybe expected, that those who need finance more are also more helped by having a shared director, because for all the three different variables of shared directors, we see that results improve when you are a financially constrained firm. So
Niels,
these are the main
Niels,
results we have now.
Niels,
Yes.
Niels, we have a hand here.
Very good.
My friend Joseph, our friend,
No,
Joseph,
it's really interesting. I couldn't wait actually before actually talking. But really an interesting result actually in Niels. I mean, I just have a quick question for you.
Sure.
Because when you look at the director with financial expertise actually,
Yeah.
I'm wondering what the percentage of those shared director with and without financial expertise actually?
Well, I think I showed you. I think it's 50%.
50%, okay.
So 50% of those shared directors, this is the table. So the last line, so 50% of all shared directors we have in our data set, they have, we have information about the fact that they have this financial or banking, I think we should change this to banking expertise, but they have this expertise that we think is important for firms to have to be able to get loans and to get also good conditions. So there is quite, there is a 50-50 breakdown here, which makes it empirically, I think, interesting.
What is that? I mean, which line is that? I can see number of.
Can you see table 2?
Yeah, I can see the table 2. Yeah,
and then the last line. So the
okay. Share director with financial expertise. Okay.
That's what. So it is really interesting to look at this, because there is variation, right?
Okay.
Okay.
Yeah.
Okay, that's it. Okay. Thank you very much. Yeah, that's very interesting. Okay.
So this is where we are now. This is where the paper stands, and I know there's lots of things we need to do. For one thing, we need to, of course, Well, we need to do a couple of things. We need to better explain in theory what's really going on. That's one thing. We need to, I think that's also one question. We need to get more details about these persons. So now it's just a dummy, but it would be far more interesting to know whether these people have long history in banking, what kind of position they took. I think Tulu's point about networking theory is something we should definitely also consider. So more about the shared director itself. And then, but that's, maybe you have ideas for this, but then also it would be good to know more about what exactly is being shared, what kind of information. That is very hard, I think, to measure for us, but that would also help strengthening the story. And then finally, of course, the always relevant question about endogeneity. So yeah, I can go to conclusion, but I don't think there's too much in there that we did not talk about. Let me see what is already 5 or 10 past 3. So I think this is the main finding. I think it's economically meaningful. I showed you some of the results. So I think that we really have something that is maybe important. I think it's the channel we should sell, which puts us apart from this literature on executives, the executive story, which is the organizational tie story that matters. Here it's really the information, the knowledge, or the banking knowledge that there is there. So yeah, and what we also may try to sell is that we add something to this resource dependency theory. First of all, because we are one of the few looking at private firms for which these interlocks might be very important, and also resource dependency is very important. So the topic in itself is very relevant for this group of firms. And then that we say that the interlock literature is basically talking about interlocks as such, but it's much more about what they carry. So, and this is work to be done.
Yeah.
Okay.
That's
it.
Yeah. Thank you, Niels. That was everything was perfect, almost perfect. So we heard the theory, we heard the empirical strategy, we heard the data, everything. So we had a lot of discussion already, but I have seen, I am now seeing a couple of hands. So I think, Joseph, you are the first in the queue, and then Richard, please.
Yeah, okay, yeah, thank you again. I mean, really a lot, Niels. This is really interesting, piece of paper. I just check also to see if the board of directors who are not shared directors, but with financial expertise to look at the result, actually, what you will get, in terms of impact on interest rate.
Yeah, I showed you the result, right?
Yeah, but that one was, okay, right, yeah.
Because if we add, so this is column 4, if we add a variable where we have non-shared directors, so other board members who may have this expertise, that doesn't add anything.
Okay, right, yeah. I was thinking, no, that's my mistake, yeah. I was thinking of, instead, I will read this one as shared directors with no financial expertise.
No.
Okay, right, that was my mistake. Okay, yeah. Okay, good. Yeah. Okay, that's also okay. Okay, thanks.
So,
thanks.
Thank you. And the next one, I saw Richard's hand, but Richard is hiding somewhere. So now the second hand is from Bo So. Please.
Yeah. Which type of firms do actually have these shared members on the board with bank expertise? Is it so that specific type of firms are looking for these people to come on the board and make the board work better, and then be able to get the better bank loan, perhaps, because then they know how to make sure that their financial statements are okay, etc. And the fact that there is someone on the board who actually understands how a bank is thinking. So I was more curious about, if you look at the sample, then what does this tell us about the type of firms? Is it fast-growing firms? Is it something to do with ownership concentration or diverse ownership and things like that. So the typical things that we would like to ask you about the firms to get some causality in the end, perhaps.
All very good questions. And so right now, we are collecting this data, but right now they're all in the firm fixed effects. So they are implicitly they are in there, but we don't specifically look at them. But it might be good to look at actually. So this financially constrained story I showed you in the last table. I think it would be interesting to do a similar kind of story for fast-growing firms versus low-growth firms, and also small versus large, because these could be categories of firms for which having access to finance is actually different. And especially for fast-growing firms, you could say, well, they might need more finance, have a higher financing need. So that would be one way to deal with this. But right now, we just have them in the firm fixed effects. But we should look at details of the type of firms who have these share directors more. I agree.
Could it also be that some banks are looking for customers also, that these people are go between here from the banking sector into the private firms to identify good borrowers?
Yeah, that raises that's of course always interesting. That has to do with endogeneity. Another question could be, what drives the fact that share directors are there? That's basically your question, right?
Yeah. Okay. So while we are waiting for more hands, so Niels, so let me ask you some questions, or maybe something that to be further clarified. So look at your result, your empirical model. I did not see the control variables on the firm level, on the CEO level, the firm's own CEO level, the firm's own board level. So do you think those factors are important for your research question? Do you need to control them? For example, if the firm's CEO, he or herself, is also a person who has the background of finance. What are the differences between this firm with and another firm whose CEO is from, let's say, physics? So when they interact with the interlocked, the shared directors, do you think they have different languages, and so that the communication, probably the level of communication is different? So in summary, do you think you need to control the CEO's characteristics, or even the firm other characteristics in your model?
Yeah.
So that's
sure.
That's my first question.
Yeah. So we have controls. I didn't show them because then the table becomes too long. But we have controls. We have controls for governance of the firm. So the standard things actually like size of the board, independence, these kind of things. We don't have CEO characteristics in there, so that might be something we could collect, I guess. Your story, might make sense in this, if the CEO is a finance person himself, that might make it easier to. I mean, information is coming to the board or is discussed in the board, and the better the board is able to, let's say, to digest this information, maybe the better the results will be. So having a CEO being able to do this, that might indeed be something to look in. It's something to look into.
Yeah. So my second question is on you mentioned the endogeneity, and I know you are the editor now, so people probably will not really picking this issue, and because some big names they are running the ordinary least square without consideration of the endogeneity. But in this case, I think in theory, this is a problem, endogenous problem. So how do you think you can deal with this? So for example, if you add another set of empirical analysis, so maybe you can go further to talk about to deal with the endogenous problem. Do you think this is an issue, or you are not worried about that?
No, I think we should definitely do more on that, because, as you know, in corporate governance, endogeneity everywhere, but certainly also in corporate governance, endogeneity is an issue. So we should do this, and we have thought about how to do this, which is always an issue.
Okay.
But there are various ways to do this. So one thing is to look at what happens if such a board member, shared director, is added to the board. What does that make? What kind of changes do you observe then? And also when the shared director leaves the board. I believe that we also have cases where that actually is true. So that's one thing we are considering doing now. But endogeneity is certainly something. If we want to sell this story to any kind of journal, we need to be much more explicit about whether this is a causal relationship, yes or no.
Yeah. So I was thinking about the DID approach, and the DID, difference in differences, does not solve this endogeneity entirely. It is more selection bias problem. But I do see the selection bias problem here, because you really exclusively almost focused on the impact of interlocking. Yeah. But I can imagine among your sample firms, not every firm has interlocked shared directors. So you say, by looking at the descriptive statistics, that the shared director actually is not that big. So that means that in your sample firms, there are many firms that do not have this shared directorship. So, but you pull them together, you are running this fixed effect, you get the average impact. That may indicate something, but for me, this is treated versus control. So you need to compare the firms that have interlocked directors with the firms that do not have. If you do the ID, you can compare them, and you can. I hope you know when they have the interlock, so you can define that post-dummy. So this is just one other options that you can consider, and you add some robustness test. So what you have here is the average effect, but you can go further to make this more explicit by comparing treated firms with controlled firms. I'm sure you have the information to define the treated, because not every firm has the shared directorship. So that's my econometric question on econometrics. My last one, and I gave the floor to my colleague. My last question is about this interlocking literature. And you mentioned that, yes, you focus on interlocking. And I remember I read some papers that they say interlocked directors, they do not only provide resources and additional information to the firm, but they may create some additional issues, agency, or conflicts. For example, I heard they are too busy. Yeah. So busy directors. So because they are going around in different firms, and they do not even have time to really seriously pay attention to the firms that they are sitting on. So in your paper, you exclusively focused on the benefits of having this interlock. But in fact, in the meantime, they create some other issues. So I would, if I go further, I would consider different approaches, and then we see which approach is dominating. I do not know whether you have the data, but for example, they are too busy and they create problems for the firms who hired them.
No.
What do you think?
No, very valid. Like I said, somewhere in the beginning, so maybe not in the beginning, but so one thing that we are working on is collecting more information about who these share directors are. And one thing is the number of positions they have. So indeed, busy directors might have a different effect than less busy or non-busy directors. There is a whole literature about busy directors. So that indeed might, I'm not sure whether it would lead to negative effects, because, well, the effect can be that they don't get loans or they don't get a reduction of interest rates, but not maybe higher interest rates. I don't think that's to be expected, but at least the positive effect that we now find may be reduced or maybe even vanish if you as a firm have a director, a shared director who is very busy, who is very central in a network. So indeed, that's something that we need to look into, and we are currently collecting data for.
Yeah, great. Thank you. So Tulu, you have another question? Tulu, please.
I'm just thinking aloud a little bit. Perhaps this may result to be a minor issue. I don't know if you consider the impact of location of these private firms, because I believe that the location of these firms may affect access to bank loans. Yep. It may also affect talent for directors.
Yeah, no, I completely agree. Also, that's on our list, on our to-do list. So I'm not sure whether you know the geography of Denmark, but Copenhagen is quite a very central, let's say, part of the country, and also some towns around it. So the location might definitely be something that is of value here, and that also is related to one of the other variables we are collecting. That's the type of the bank. So is it a nationwide bank? Is it a more, let's say, a local bank? Yeah. So the type of the bank, that may also play a role here. So location is, together with the type of the bank, is definitely something that we are looking for. You see, right? This is I present you asked me to present the paper, and then I thought, okay, but I have a paper that's by far finished. But actually, that's good, because then I can get a lot of comments from you.
Yeah. Another issue before I leave the floor, it's perhaps in your robustness test, you should look at turnover of these directors. So you use dummy variable, for example, to represent presence of interlocks. Perhaps what happens if a firm with interlock, it changes to a firm without interlock? So what happens to your dependent variables?
Yeah. Well, that will be part of the more deeper analysis of the, let's say, the causal effects that we are trying to get here.
Yeah.
So that's definitely something that we should do. Yeah. Because we have those cases, right? So.
Yeah. Thanks a lot.
Yeah. Thank you for your comments.
Interesting stuff.
Thank you.
Yeah, it's really, really good. So thanks for the questions. Do we have more questions? Wow, it's a really good session, and everybody has been very busy in thinking with Niels, and I think Niels, you are more relaxed than us, but it's a good session. So I think we thought a lot about this interlocking directorship, and oh, I forgot one thing. Niels, because you talk about financing, I'm thinking, for policy implications, can we say that in general? So if I change, an interlock director is a marketing person, do you think your sales or your marketing performance will be increased by this kind of interlocking? So this is banking person. So your finance problem is particularly, financial position is benefited. But if you change the nature of, change the background of this interlocked directorship, salesperson, or maybe what else? Innovation, a tech person. If I have a tech person as an interlocked, can we derive the general implication that we say that person will be very good for the firm's innovation? Can you do that? Can we say that?
Well, that's something I have to think about. I mean, one thing I could imagine is that it could make the paper in a way stronger if we suppose we have 3 different types of interlocks: marketing, finance, IT, and we can find results that are similar, saying that indeed this information, the flow of information about these type of things, and to banking, loan access, to better marketing performance, then you have a very general story about the idea that the interlock and the information it holds is indeed very important for a firm. I'm not sure whether that's the way we should go, but it's an interesting thought.
Yeah, because I was thinking, so what happens if I have the tech person, and then can we derive the conclusion? So that's my last one. But I think, I actually abused the power of being a chair today. So I inserted in my another question. I learned a lot of news. I think I particularly like the way that you presented, because you do not say what it is, you explained why it is. And this is so important and so stimulating. So thank you, Niels. And I really enjoyed the questions put forward by my colleagues here. And I do think everybody has learned a lot.
Well, Niels, thank you very much once again for inviting me, and for the audience who has been very helpful in giving me a lot of thoughts. I go to Copenhagen with a lot of things I can talk about with my colleagues. Thank you very much.
Great. Thank you so much, everybody.